investors will be happy to say goodbye to August, an incredibly volatile month for the stock market. John Bogle, the founder of the Vanguard Group, joins us now with his perspective. So, John, it has been quite a month. What's your take on how investors should react in the aftermath?
Well, first I'd like to make a distinction, Poppy, about the difference between an investor and a speculator. I mean, this kind of volatility in the market is entirely caused by speculators. People that are trying to catch the latest wave of sentiment, the latest words of the Fed, the latest developments in Europe, the latest problems in Washington, and the latest economic data. And that has very little to do with a long-term economic plan. And so I'd say try and ignore the noise. The rule for most things in life is don't just stand there, do something. But in these kind of circumstances, and for the long-term investor, the rule should be don't do something, just stand there.
You said earlier this month, not long ago, that we are likely heading into a second recession for the United States, right? Or that we could be.
I think the chances are probably 50-50 at least, that we're going into a double dip.
Given that, how should investors react? I mean, should they get out now and sell at these levels if we are falling into another recession?
Well, I mean, I think you should invest for the long term. And if you're investing for a lifetime or for the next 15, 20 years, whatever it might be, in that period, looking ahead, there are going to be a certain number of recessions, a certain number of booms, a certain number of good times and some bad times. That's the way the markets are. And to try and get in at the bottom and out at the top is simply impossible for anybody. But it's a very good bet that stocks will do significantly better than bonds over the coming decade.
How would you advise investors looking at commodities right now? I mean, there's been such a rush into gold, especially lately, but really over the past few years. Is gold at these levels a wise investment for an average investor?
Well, I think no. And the reason I say no is gold is not an investment at all. Gold, to go back to where we started, Poppy, is a speculation. It has absolutely no underlying intrinsic value. You know, bonds are ultimately supported by interest coupons. Stocks are supported by dividend yields and earnings growth. And gold is supported by, well, the ability to think somebody else is going to take it off your hands for more than you paid for it. It doesn't have an internal rate of return. So it's a speculation. Is it a good speculation today? I don't know that I'd be much of an expert on that, but it's gone so high so far that I'd be very skeptical of it. But if you really are bitten by the gold bug, and it seems like an awful lot of people have been bitten by the gold bug, and if you want to speculate, maybe 1 or 2 or 3 or even 5% of your assets in gold is not the worst idea in the world, but I wouldn't do it myself, and I wouldn't advise most investors to do it.
What about corporate bonds? What's your take on those right now?
Well, I mean, I think corporate bonds are, in the AA area, have good premium yields over the treasuries. You want to be very diversified, and I would certainly recommend a bond index fund, a corporate bond index fund perhaps, or a total bond market index fund, which is dominated by treasuries and mortgage backs. But diversify that corporate position, because one bond can cost you a lot if you're on the losing side of the game.
You know, there is this feeling among some just Main Street investors, if you will, who are telling me, look, I feel as though high-frequency trading is really taking over this market, and I can't play in that game. What would you say to them? I mean, how much of the volatility over the month of August would you attribute to high-frequency traders, and what does it do to the average investor's ability?
Well, average investors should absolutely, as they say, I can't play in that game, was I think the quote you used. They shouldn't play in that game. It's like going to Las Vegas and gambling. Why would anybody want to do that when you know that the house takes more than the winnings than the winners and losers combined? It's not a zero-sum game. It's a loser's game, whether you're at the racetrack or at the state lottery or in Las Vegas. Ultimately, you lose. Pick your stock market, pick your bond market, pick your stocks even if you buy a very diversified list, and then get out of the game because you can't play it. The cards are really stacked against you with this high-frequency trading, and we should be looking at long-term investing the wisdom of long-term investing, Poppy, is the way I'd express it, and just ignore the folly of short-term speculation. It's absolutely a loser's game.